All right, today we're going to break down one of the most important concepts in finance. What exactly is a stock? We're going to do it in the simplest way possible. No confusing jargon, no hype, just the straight up facts so you can really understand it. So let's kick things off with a pretty wild idea. What if I told you that the biggest, most powerful companies on Earth aren't owned by some single person in a fancy boardroom? What if they were actually owned by millions of regular people, just like you? The crazy part is, most of them probably don't even realize they're part owners. And that right there is the core idea behind a stock. Okay, so let's get right down to it. What is a stock when you strip away all the complexity? At its heart, a stock is simply a small slice of ownership in a company. That's it. When you buy a stock, you're not just buying a ticker symbol on a screen. You are literally buying a tiny fraction of that entire business. So if the business does well, your little slice becomes more valuable. If it struggles, well, your slice can lose value. Yeah, it's that direct. You know, the easiest way to think about this is with pizza. Everybody gets pizza, right? So imagine a company is one giant whole pizza. To raise money, the company decides to cut that pizza into millions, maybe even billions, of identical little slices. Each one of those slices is what we call a share of stock. When you buy one, you own a piece of the whole pizza. And this right here, this is a huge mental shift you have to make. Buying a stock isn't like buying a lottery ticket or placing a bet in a casino. You're not gambling, you are becoming a part owner of a real business that makes real things or sells real services.
Okay, but that probably makes you wonder, right? If a company is so great and successful, why on earth would it want to sell off little pieces of itself to strangers?
Yeah, exactly. If your pizza is so good, why would you sell off the slices? What's the catch? What's in it for them? Well, the answer really boils down to one word: growth. Companies need cash, what we call capital, to get bigger and better. They might want that money to open new stores or to fund the research for a cool new product. Maybe they want to expand into other countries, or maybe they just want to pay off some debt to make their finances stronger. Selling those slices of pizza is how they raise that cash. You've probably heard this term thrown around in the news, right? It's called going public or having an IPO, which stands for Initial Public Offering. That's just the moment a private company offers its shares for the very first time on a public stock exchange, where pretty much anyone can buy and sell them. All right, so we know what stocks are, we know why companies sell them. Now for the million-dollar question. Literally, how do you actually make money from owning them? Well, it's actually pretty straightforward. It basically boils down to two main ways. It's not nearly as complicated as it sounds. The first way is what most people think of: price appreciation. Simple, right? You buy a share for, let's say, $10. If the company does well over the years, other people might be willing to pay $20 for that same share. If you sell it, boom, you've made a profit. The second way is through dividends. Think of this like a little thank you bonus. Some big established companies will share a portion of their profits directly with their owners, the shareholders. It's a cash reward just for being an owner. Okay, but what about the prices? They jump all over the place, right? It looks like a total roller coaster. In the short term, yeah, a lot of that is driven by news, by hype, and just plain old human emotion. But here's the key thing to remember. Over the long term, a stock's price almost always follows the actual success of the business behind it. And all that jumping around, that volatility, it naturally brings up the big elephant in the room for anyone new to this: risk. So let's tackle that head on. Look, let's be real. Are stocks risky? Of course they are. Prices can go down and companies can even go out of business. But just asking, is it risky? That's not really the right question to ask. A way better question, the one that really matters, is this: do I understand what I am buying? Seriously, this one question changes the entire game. Most of the time, people lose money not because stocks are bad, but because they put their money into something they just don't get. And that right there is the massive difference between real investing and pure speculation. A speculator is basically treating a stock like a lottery ticket. They're just hoping to get lucky. An investor, though, they understand they are buying a piece of a business, and they know their success is tied to the long-term success of that company. So how do we make sure we're investors and not speculators? It all comes down to adopting the right mindset from the get-go. Look, your decision to buy a piece of a company shouldn't come from a random tip or what's trending on social media. Your conviction has to be built on your own research and your own understanding of that business. And listen, you don't have to be some Wall Street genius to do this. It's really just about asking basic common sense questions, just like you would if you were buying a whole business. Stuff like, how does this company actually make its money? Is it actually profitable? Does it have a realistic way to grow in the future? And is it financially healthy, or is it just buried in debt?
So let's wrap this all up with one final thought that just hits the nail on the head. Investing without understanding is just speculation. And speculation is not a real strategy for building wealth over the long haul. The foundation of it all is so simple. When you buy a stock, know what you own.